Something really interesting is happening with AI stocks right now. Wall Street is getting quietly but very, very worried, and I don't think most people have caught on yet. Think about it. Not that long ago, any company that even mentioned a big AI investment would see its stock just take off. But now, we're seeing the exact opposite. See ya. Let's dive into what's really going on here.
So this is the big mystery we need to unpack. Why on earth are these massive, multi-billion-dollar investments in AI, the future of technology, suddenly punishing the stocks of the companies making these huge bets? It's a total paradox, and it's starting to send some serious shockwaves through the market.
And this right here just shows you how much things have changed and how fast. Just a year ago, investing in AI was like a magic phrase for Wall Street. You'd say it and your stock would just fly. But fast forward to today, Meta announces a $30 billion AI investment. And what happens? The stock doesn't soar, it craters 11%. That's its worst day in 3 years. And we're seeing the same story play out with Oracle. The market's reaction has completely flipped on its head.
Now, you might be sitting there thinking, okay, that's interesting, but this is just a story for day traders and tech junkies, right? Well, not exactly. The reality is, this has a huge ripple effect that could impact anyone with money in the market, especially if you have a 401k. Let me show you why.
Okay, so you've probably heard of the S&P 500. It's basically the benchmark for the whole U.S. stock market. The thing is, it's become incredibly top-heavy. Just 7 companies, we call them the Magnificent Seven, Apple, Microsoft, Meta. They now make up more than a third of the entire index. And guess what they all have in common? They are all going all in on AI.
And here's the bottom line. The health of your retirement account is now directly tied to how these few, giant AI-obsessed companies are doing. If they start to stumble because of all this massive spending, they don't fall alone. They can drag the entire market, and yup, your 401k, down with them.
So what's the real problem here? What's the thing that's actually making Wall Street nervous? Well, it's not the technology. Let's be clear, they still believe in AI. The real anxiety is about something much older and much more fundamental. It's the colossal mountain of debt these companies are piling up to fund this whole race. A recent Bank of America report just dropped an absolute bombshell. It found that tech companies are on track to spend 94% of their operating cash flow on AI infrastructure. Just let that sink in for a second. They're spending nearly every single dollar they make from their regular business, and that's still not enough.
So, when your spending is way more than the cash you have coming in the door, you've got to find that money somewhere else, right? And to cover these insane costs, these tech giants are heading to the debt markets and borrowing like we've never seen before.
The number is just staggering. In the last year alone, tech companies have borrowed $121 billion. It's a figure that's almost hard to wrap your head around, but let's put it into perspective.
Now, here's what makes that number truly mind-boggling. That $121 billion, it's 4 times the average amount these same companies borrowed over the last 5 years. So they're not just spending a little more, they are leveraging themselves up at a rate that is completely unprecedented.
This much debt, as you can imagine, creates some serious risk, and we're starting to see the proof in the bond market. Take Oracle, for example. They're borrowing so much cash for AI that investors are now treating their bonds like they're junk bonds. That means they're demanding super high interest rates because they're getting legitimately worried that Oracle might not be able to pay all that money back.
And if you thought that was worrying, listen to this. The cost to buy insurance against Oracle going bankrupt, it's called a credit default swap, is now at its highest level since the 2009 financial crisis. Let me say that again. The market is pricing in a level of risk for a major tech company that we haven't seen since the great financial crash. That's a huge deal.
Does this whole scenario of borrowing massive amounts of money to chase a hot new technology, does that ring a bell? Because yeah, it should. We have definitely seen this movie before.
Think back to the 1990s and the dot-com bubble. Companies borrowed billions and billions to win the internet race. The bet was enormous. Spend whatever it takes to build out the infrastructure first. Now, some of those companies became the giants we know today, but many, many others went bankrupt, absolutely buried under all that debt they took on. Because in a race this expensive, there are always casualties. So with all this risk and all these historical echoes swirling around, how are the smart money players on Wall Street handling it? Well, they're not panicking. Their whole mindset is just shifting from blind enthusiasm to being really, really picky.
This is such a fascinating shift. Just a year ago, AI stocks had an 80% correlation. That means if one went up, pretty much all of them went up together. The herd mentality was simple. If it has AI in the name, buy it. But today, that correlation has plummeted to just 20%. The herd is gone. Investors are no longer just buying the hype. They're demanding to see a clear, believable path to actual revenue.
So what are these newly picky investors looking for? Well, they're watching for 4 key red flags. First, negative free cash flow, which just means a company is burning through more cash than it's making. Second, widening credit spreads. That's just a fancy term for what we saw with Oracle, where investors demand higher interest because they see more risk. Third, and this is a big one, a lack of real, tangible revenue growth from all this AI spending. And finally, number 4, any sudden slowdown in that spending, which could be a signal that the well is starting to run dry.
Okay, I know hearing all this about debt and risk and red flags might sound, well, pretty scary. But here's the thing that experienced investors know. In the financial markets, a crisis or a big shakeout is often just another word for opportunity.
Let's be perfectly clear. AI is not going away. It's a genuinely transformative technology, and it's here to stay. But, and this is the crucial point, not every company borrowing insane amounts of money to chase that transformation is going to survive the journey. That mountain of debt creates enormous risk, and it's almost guaranteed that some will fail.
And this quote just absolutely nails the dynamic we're heading into. Eventually, one of these big, over-leveraged AI companies is going to go bust. It's going to trigger panic, the headlines will be screaming about a bubble bursting, but that fear, that is exactly where the opportunity is for people who are prepared.
This is a classic market cycle, and it's all driven by that debt we've been talking about. When the downturn finally hits, you're going to see people who invest based on headlines panic and sell everything. But the financially savvy, long-term investors, they're going to see it as a fire sale, a chance to buy great companies and quality assets at a huge discount.
So that leaves us with one final thought. The signals from Wall Street are getting clear. An AI shakeout is on the horizon. The only question left is, when it finally arrives, are you going to be caught up in the fear, or will you be prepared enough to see the opportunity?